This is your Swap Hunt Daily News for March 5, 2026. The owner of the New York Stock Exchange just invested $25 billion in crypto exchange, OKX, and that's just the start of today's headlines. Markets are flashing a contradictory signal today. The broader regime remains technically bullish, with Bitcoin holding above its 20-day moving average, but sentiment tells a different story, sitting deep in extreme fear territory. That said, fear has improved sharply from yesterday's reading, suggesting the worst of the panic may be easing. The total crypto market cap pulled back over the past 24 hours as broad selling pressure continued across major assets. Bitcoin ran as high as 74,000 before pulling back, and altcoins remain under pressure across the board. It's a market where institutional buying and retail fear are running in opposite directions. Intercontinental Exchange, the parent company of the New York Stock Exchange, has made a landmark investment in OKX, one of the world's largest crypto exchanges, valuing OKX at $25 billion. As part of the deal, ICE will take a board seat at OKX. This is not a passive financial bet. The partnership has a specific operational goal: to bring tokenized versions of NYSE-listed stocks and derivatives to OKX's global user base. The plan is to have these products live by 2026. Tokenizing stocks means representing traditional equity ownership on a blockchain, which could dramatically reduce settlement times, lower the cost of cross-border trading, and open NYSE-listed securities to investors who currently lack access to U.S. markets. For OKX, gaining ICE's regulatory knowledge and infrastructure is a major legitimacy upgrade. For ICE, this is a calculated move to stay relevant as financial infrastructure shifts toward blockchain rails. The implications for the broader market are significant. If the NYSE's owner is willing to put $25 billion behind a crypto exchange and commit to tokenizing its own listed securities, it signals that the on-chain economy is no longer a fringe experiment. This is institutional finance placing a structural bet on the direction of global markets. Bitcoin ETFs recorded $462 million in a single day of inflows, with BlackRock's IBIT alone absorbing $307 million. This marks the third consecutive day of inflows totaling over $1.1 billion combined. Nearly every U.S. spot Bitcoin ETF posted positive flows on the same day. The timing is notable. This institutional buying is happening while the Fear and Greed Index sits in extreme fear territory, a classic divergence between retail sentiment and institutional positioning. Glassnode did issue a cautionary note alongside the positive flow data, flagging that underlying demand remains fragile and could reverse quickly. But the raw numbers are hard to dismiss. $1.1 billion flowing into regulated Bitcoin products over 3 consecutive days represents real, sustained institutional conviction. BlackRock's dominance within that figure is also significant. IBIT has become the go-to vehicle for large allocators seeking Bitcoin exposure through traditional channels. The question the market is now asking is whether this inflow streak can hold as Bitcoin navigates key technical resistance levels. If institutional buying continues at this pace, the supply pressure from ETF accumulation could become a meaningful factor in price discovery. Michael Saylor has put forward a structural argument for why Bitcoin has struggled to sustain aggressive gains, and it has nothing to do with fundamentals. In an interview with Coin Stories host Nathalie Brunel, Saylor argued that Bitcoin's price ceiling is being mechanically suppressed by a broken credit market. His thesis centers on rehypothecation in what he calls shadow banking. Here's the problem as he frames it. Roughly $2 trillion worth of Bitcoin exists globally. Of that, approximately $1.8 trillion sits with retail holders and offshore investors who have no access to traditional banking credit. If you hold Apple stock, you can borrow against it at a bank for a modest premium over the benchmark rate. Bitcoin holders can't do that. Banks are only beginning to accept Bitcoin as collateral, and even then at a snail's pace. This forces holders into shadow financing channels, where counterparties will offer ultra-low or even 0% loans in exchange for taking custody of the Bitcoin, and then rehypothecate it for further lending. That rehypothecation, Saylor argues, creates a persistent mechanical selling pressure that caps upside and amplifies downside moves. His conclusion is that until a conventional, non-rehypothecating credit system matures around Bitcoin, one that resembles normal securities financing, the asset will continue to experience this structural drag. Saylor framed this as a temporary bottleneck, not a flaw in the thesis. Ripple has achieved something no crypto company has managed before. Hidden Road Partners, acquired and rebranded by Ripple as Ripple Prime, was listed in the National Securities Clearing Corporation directory under the Depository Trust and Clearing Corporation, the DTCC, on March 2, 2026. For context, the DTCC is the backbone of post-trade settlement in U.S. financial markets. Getting listed means Ripple Prime now has direct operational standing within Wall Street's clearing infrastructure, enabling it to process over-the-counter trades through the NYSE's centralized system. Before this milestone, Hidden Road was already a significant institution, processing financing trades for over 300 institutional clients and handling approximately $3 trillion annually. This listing makes Ripple the first crypto-native company embedded directly into the machinery of traditional finance at this level. Former Ripple CTO David Schwartz acknowledged the development as important, a notably understated endorsement from someone inside the company. The implication for the XRP ledger is that Ripple Prime may progressively shift parts of its post-trade processing onto the blockchain, driving real utility and institutional volume through XRP's settlement rails. This is not a speculative roadmap item. The infrastructure is now live and registered. Robinhood's head of crypto has outlined the company's plan to build its own Ethereum Layer 2 network, and the reasoning behind choosing Ethereum is worth unpacking. Rather than launching a proprietary Layer 1 blockchain like many competitors, Robinhood is betting on Ethereum's security model and its wide validator distribution as foundational advantages that can't easily be replicated. The focus is on real usability barriers, the friction that has kept mainstream users away from on-chain financial activity rather than simply capturing market share within the existing crypto ecosystem. One key driver in the decision is liquidity. Robinhood wants to bring traditional assets like stocks on-chain, and that kind of tokenization requires deep, accessible liquidity across EVM-compatible chains. Isolated or closed-loop ecosystems can't deliver that at scale. By building on Ethereum, Robinhood positions itself within the most liquid smart contract ecosystem globally. The broader vision articulated aligns with Vitalik Buterin's concept of Ethereum as infrastructure for storing value, coordinating activity, and communicating securely without relying on centralized intermediaries. For a retail brokerage serving tens of millions of users, this is a significant strategic signal. Robinhood is treating on-chain finance as a serious long-term product direction, not a side feature. That's your daily crypto roundup for March 5th. If this helped you stay informed, subscribe to SwapHunt HQ here on YouTube and follow SwapHunt on X for real-time market alerts. We'll see you tomorrow.